Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Kieran Goodwin's roots go back to the early days of both the stressed debt investing and the credit default swap market, two classes of risk he has seen experience significant change over the last 25 years. Our conversation gets underway by exploring the notion of alpha decay in the distressed market, a diminished opportunity set that has resulted from smarter capital entering the space equipped with an understanding of the often complicated process around bankruptcy and reorganization. Kieran frames out the option characteristics of distressed investing in an interesting way, suggesting that the long or short profile of the exposure is about whether time is on your side or not, while also arguing that it is arming yourself with a margin of safety and price that creates this runway, leaving the trade with more long vol attributes. Distressed investing today, in Kieran's view, is an adult swim-only business, rife with creditor-on-creditor violence and requiring a large balance sheet to be in the room as indentures are changed or portions of a capital structure are being primed. We spend the remaining part of the discussion on the CLO business and the potential for a credit widening cycle. Kieran describes the CLO machinery as a captive buyer base for loans that has served as a quasi-index product that has facilitated market growth. While noting that the product has indeed been effective over the years, he points to concentration risk that can lead to a rapid rise in correlations and spreads. He also points to at least some early signs of an uptick in defaults. Lastly, we touch on the electronification of credit trading and the factorization of credit exposure that technology has increasingly enabled. Involved as an investor in some of the initiatives to facilitate electronic trading, Kieran sees further growth here accompanied by more continuous trading and price discovery. I hope you enjoy this episode of the Alpha Exchange, my conversation with Kieran Goodwin. My guest today on the Alpha Exchange is Kieran Goodwin. He is a hedge fund founder, video game creator, advisor to several funds, and a thinker on all matters of risk. Kieran, it's great to reconnect, and thanks for being a guest on the podcast.
Happy to be here, Dean. Always enjoy conversing with you about all the arcane matters of the market.
Yeah, we've connected over the years on vol and optionality. That'll be some portion of our conversation. I was just looking back through old emails, and you'd reached out to me, gosh, I think it's 2018, around a podcast I did with Chris Cole. So it was one of the first ones. And I'm 150 odd episodes in and running strong based on the likes of being able to engage with guests like you. So thank you. You've had a long career in markets. You've done a lot. You started on the sell side. You were one of the earlier participants in the credit derivatives markets. You spent a lot of time at King Street running trading, founded Panning for a number of years, and now you're kind of looking around and evaluating things. So we'll have a lot to talk about. Why don't we just go back a little bit and talk about some of your early days in the distressed industry, that asset class, the credit derivatives asset class. I'm always interested in speaking to folks like you who've been at this a long time and evaluating change. And so maybe take us back to some of the early days in distressed. One of the things I picked up on in another podcast you did was this sort of idea of alpha decay in distress, that a secret doesn't stay a secret when there's profits to be had. I'd love for you to run through that with respect to the distressed industry and how maybe its expertise or technology have effectively arbed away some of the alpha that you saw in your early days.
So, I went to the buy side in 2002, and I was like a prop trader after being one of the first market makers in credit derivatives. And I think one of my insights about credit derivatives and application was the fact that you could be short via owning CDS, and you had a known downside to premium, and your upside is if the company actually defaulted, when the distress would be kind of par minus the recovery. So pitching that trade to many much smarter credit investors, I was came from the derivative side. I started understanding their mindset and distress, and like Fran Biondi at King Street, as far as a distressed investor, was an early adopter of credit derivatives because King Street always thought about the short side. They were kind of a short-long credit fund where sometimes they would short the credits that they thought would eventually be distressed and then go long them. And then trading prop on myself, went through the defaults of WorldCom and Adelphia in the kind of TMT blow up of 2002, and then had a chance to join King Street in 2004 after having known Fran and Brian from 1999, really because I wanted to learn more about distress, really where was the alpha created. And getting there, they had on the Enron trade on, that was a big position for them at the time. From 2001, even 2004 and 2005, they were still reaping the fruit of that trade. And yeah, the process of distress wasn't really widely known. I mean, you had a handful of participants that mostly kind of came out of the late 80s, early 90s cycle that then spun off into hedge funds that really understood Chapter 11 and the reorganization of such. And there was alpha just in getting court documents before the next fund. So this informational edge that 15 to 25 distress investors had over the rest of the market was real. There was more of a silo with respect of the credit market participants, meaning like insurance company, they were forced to sell it when a credit came distressed or got to rated triple C because they didn't necessarily have their own reorganization unit internally. So going through the process and trying to find good assets, good companies with bad balance sheets, there was a lot to choose from, especially after the tech bubble. And as you're describing, like, I just believe when you have knowledge in a particular institution, eventually there's going to be an osmosis of that knowledge as people leave that institution or create their own fund or go back to the sell side or what have you, and you need to find new alpha. And taking 2010 to 2012 off after I left King Street, and clearly there's sometimes when there's just a flood of defaults, like in 2008, where if you have capital, you're going to be able to find opportunity. But one of the big differences in those 2 years was the emergence of Reorg Research, which is a third-party provider of research for distressed and stress situations. So now the whole process was pretty much anyone signed up to get top quality research, and you had to find a different angle to attack, which was the beginning of creditor on creditor violence, which is taking on new forms every day right now. So that's a little bit of my perspective on the change.
So when we think about credit investing, providing capital and then taking some default risk in pursuit of some return above the risk-free rate, you're typically framed as being short volatility, right? That's what the Merton model would tell us about the spread premium as being some variation of the Black-Scholes option premium. When you think about distressed, can you definitively say that you're long or short vol? Is it very situation specific? Are there situations in which a distressed investor finds him or herself long vol versus short vol? Tell us a little bit more about distressed investing from an optionality standpoint.
Yeah, it's a great question. You want a margin of safety because the process, not only is it, as talking about a reorganization process, not only is it many times uncertain on which class in the capital structure, how is this distribution of assets going to occur, but also it's very costly. You have the advisors, the financial advisors, you have legal, you have auditors, and the bills that you rack up, the entity you rack up, the estate racks up are massive. So the debt holders at that point, ultimately, they're paying for it. So when I think about long and short volatility with the distress, like one word that pops to mind is obsolescence risk. Mostly a company files, it goes into Chapter 11, then it goes into Chapter 7. I guess every once in a while you have a Chapter 7 right to liquidation. But does this company need to exist? And will the burden of a reorganization be too much to bear, such that like its competitors can take customers or its assets depreciate too quickly, its employees leave? I mean, you have a ton of risk. So I do think that many times, like, you're short vol in that situation when a smaller company goes into reorganization, or in a more competitive field where capital expenditures are required constantly. And then conversely, if you have hard assets and it's a bigger real estate, I mean, if you think about the Lehman as a good example, in 2008, the operations pretty much stopped of the broker dealer, and you were left with these assets, many of which were hard assets, and obviously you had much more liabilities. But you didn't have to worry about as much as the erosion of the assets from an operational perspective. So then if you were like, hey, I have some margin of safety here, and we are in a depressed environment with respect to financial assets, real estate assets, then I would say you were long volatility. Some of the low print on Lehman, was 8 cents on the dollar. And I think unsecured recovered around 40 or so. And again, they had the benefit of all the QE and rates got cut and real estate got back bid up. So there are a lot of positives, but there was definitely enough margin of safety that it was a cheap way to be long post the financial crisis.
It's a great way to frame the question, which is around how much cushion you have. There's that old saying, there's no bad securities, only bad prices. And the scariest security becomes investable at the right price.
I do think time is the key there. Theta is the key, right? Like when time is on your side in a Lehman, then you're long vol. When time is against you, I think you're short vol. That's just one generic way of saying it.
Yeah, no, that's well framed. I wanted to get your take on the early days at King Street. So as you said, you're coming off a distressed cycle, the telco distressed cycle. Of course, there's a lot of fraud, accounting fraud with WorldCom and Tyco and Adelphia mixed in there. But these assets are investable just by way of this margin of safety. And then we go through this 4 or 5 year period, the housing bubble and all the securitization that's built around the bubble is complicit in it, but we effectively erode this margin of safety to nil by early 07. We've got this giant complex of financial assets built really with very little margin of safety. You'll know better than I do, but I think the 5-year IG went to 20 odd basis points. Morgan Stanley traded at 20 basis points on a 5-year CDS. King Street did really well in managing through that when a lot of other firms just really blew up. What was that like, just in terms of playing defense, and what was the right mix of defensive positions that helped you manage through that incredibly volatile period from, call it mid 07 to mid 09?
Fran and Brian, when they started the firm, they quickly thought about the short side. I'm not saying right away, but they were curing us to start doing credit derivative trades in 99. Then I joined in 04. And my experience and knowledge in the space, it was definitely synergistic to their acumen as credit investors and their perspective is thinking about the downside, thinking about the short side. So I think it was very much the culture of the firm, which helped. And we were constantly worried about what was the downside. And then seeing, as you say, everything being priced for perfection, and then having some pretty alarming conversations with the sell side with respect to subprime and all the securitizations and what had to go right. I mean, one of the conversations we had where it's like, if home price appreciation was flat for 2 years, then subprime securitizations kind of blow up because they only had like a 2-year teaser rate and they needed home price appreciation. Anyway, that just struck us as like, well, I've had a house. I mean, I'm sitting in my apartment I've been in for 15 years, and there's definitely been many years where they've been flat, and like that didn't seem like that unlikely. And then as you talk about securitization, like I think the early 2000s when rates got cut and the combination of derivatives and securitizations kind of came together from the early 90s. Then you had synthetic CDOs in every asset class, and it was just like a science experiment, obviously gone wrong. So the price perfection, and we just believed in contagion. I still believe in contagion. And I think most of the people that were at King Street at the time, we thought that was a real risk. Also, during that time in the credit market, we had some massive LBOs going on, which were going to require, which today doesn't seem like a lot, but $5-10 billion of syndicated bank loans. And like, how is this going to get done? And it was all just piling up. And we were just like, all right, how can we protect ourselves? And we knew a lot about credit derivatives in the short side. And as you say, spreads were really tight. So you didn't have to be a hero. You could buy CDS on investment grade names below 50 basis points. And, some of them turned out to be 100-to-1 payouts.
Amazing. You referenced this concept of contagion, which was a lot of things. Obviously, it invokes thoughts around systemic risk and counterparty risk in the financial system, but it's also about hidden correlations and just trying to press ourselves to just think almost creatively about what the linkages are that may not be in plain sight. I wanted to just go back to call it 06, 07 giddy period of 10 VIX and these ultra low credit spreads with just a lot of leverage in the investment banks, 30 to 35x. I mean, it was reasonably in plain sight. And I was at Bank of America. I was on a management committee that interacted with a lot of the other asset classes. So I was the equity derivatives guy. And Brian Higgins' brother, Patrick, was a mortgage salesperson running a desk at B of A at the time. And he used to always talk about the Magnetar trade. And it just got me so interested in trying to understand what was happening in this sister asset class. And what I noticed, Kieran, was good for my desk. Our trades just got bigger and bigger. And then I realized after interacting with some folks on the CDS side that those trades were just enormous, orders of magnitudes bigger than the prints that we were putting up on the equity derivative side. It's just a fascinating thing to sort of think back on and the why and how of how we got to that very exposed state. You said around taking down the loans for the buyouts, just incredibly exposed to something going wrong.
The problem was, I remember being on the sell side, and gosh, we're so old, we're talking a long time ago, but when we were first signing up accounts 25 years ago to do CDS, you want to have an ISDA agreement with them. And part of the ISDA agreement is the upfront margin that they're going to post if they are selling CDS. And then the variable margin as the position, if it moves against them, the counterparty has to post additional margin. And this idea of margin in derivatives, if you think about the CBOE or any kind of exchange that trades options or futures, initial margin and then variable margin, that's posted all the time. So in CDS, though, there was somewhat of a race to the bottom. If a counterparty that was rated AA or AAA was selling CDS on a credit risk that was deemed to be AAA, and they were collecting 15, 20 basis points, and the salesperson or whoever wanted to get the trade done would be like, well, they don't want to post any margin because they're AAA and this risk is AAA. And what's the chances of both this risk blowing up and then blowing up? And like we talk about correlations, actually the chances were a lot higher than we thought. So there were many entities that were able to not post margin and basically sell options. And that started with Berkshire Hathaway. And they did it in every product, right? They did it in out of the money options and S&P. Yeah, they were just like, we're Berkshire, we're not going to post margin. Because the downside of posting margin is that you don't have use of that capital. So then other AAAs, which weren't as good as Berkshire. So I don't necessarily blame Berkshire for doing what they did, because you could argue that he is the best. But he was AAA, or Berkshire was AAA, Warren Buffett being Berkshire somewhat. But AIG was AAA as well. And AIG was obviously, as we saw, far short as far as financial acumen of Berkshire Hathaway. But they were able to not have to post margin. So if you're not posting margin and you can sell protection, the return on capital is infinite. And when people think that they're in a free money trade, they tend to do as much as they can. So, I mean, that was why the trades got to be so big, because no one was posting margin. And then the variable margin, it was based on downgrades. And then obviously when AIG got downgraded and the AAA risk in subprime that they sold, or even in corporates, was billions of dollars, they didn't have the money. So the correlation was one. if AIG was forced to post margin from the get-go, the subprime blow up, I mean, it would have been big on balance sheet, but not nearly as big as it was because there wouldn't have been as big of off balance sheet situation.
No, I think it's a great point. So much of the outcomes of positioning are a function of the rules of the road. And with AIG, I think it's a really underappreciated acceleration in the financial crisis. And of course, AIG went down effectively the same week as Lehman, but it was really that downgrade from AAA to something different that forced them to start posting. And there's a great book on it. It's called Fatal Risk, undercovered, in my opinion, around the financial crisis. It specifically deals with AIGFP. And they talk a lot about the history of the financial products unit, which actually had a great reputation for risk management. And they just lost their way. Joe Cassano got bigger and bigger. And you were a hero. As you said, it's an infinite return when you don't have to post. And when there are no defaults, that margin of safety or lack of it just doesn't matter. And there's a great line in the book where when they did have to post, as you call it, quote, variation margin, the back office basically had to get out a dictionary and look up what the word meant. They didn't even understand the concept. It's pretty fascinating. So I think one of the themes is this idea of liquidity that just sort of comes and goes much more quickly than folks appreciate. I've heard you talk about gating, not just in hedge funds, but in mutual funds. I thought we might just have you talk a little bit about the UK pension short-lived but pretty intense debacle in, I want to say it's September or October of 2022. Basically a systemic risk event. I mean, anytime you have to get your central bank involved, it's a pretty big deal. And so you have this goal of hedging and you blow up on hedging because of mark-to-market risk. What does that tell you about how quickly we can jump from something that's liquid to illiquid?
The best hedge is like not having to hedge, like the business is hedged. I mean, anytime you have multiple legs when you're running an asset liability structure, it just gets harder and harder. And also, it's just like whether it's the UK pensions or insurance and also Silicon Valley Bank and just B of A, like the hole that was in B of A's balance sheet for a while. It's just these unintended consequences, right? Like, I mean, it gets back to volatility. Volatility is never good for leverage. If you're unlevered and you're long equity, volatility is good for you, assuming you have a portfolio of equity, right? Because like you're going to have some wins, you're going to have some losses, but your losses are capped to what you invested and your wins are potentially unlimited. But when you get leverage, when you have liabilities in general, we talk about, you said it before, credit, you're short vol. But I just think anytime you're levered, so if you're funding longs assets with liabilities, you're short vol. Because we even saw in Silicon Valley Bank this idea that deposits, you could have argued that that was a great source of funding during the financial crisis as opposed to repo. But now, and maybe because of social media or just the actual education or just of the depositors, or basically depositors were a highly correlated group, short-term deposits are short vol. So I think it comes back to like anytime you have a system that's levered, if you have massive change, and volatility is just kind of measuring change, whether it's equity price change or interest rate change, as we just had last year, or credit spread change, there's going to be unintended consequences. Not every financial entity is going to be able to get through that change without some holes in the balance sheet.
When it comes to risk premiums, it seems that we should be weary when the marginal price setter is an especially mark-to-market sensitive investor. I go back to LTCM. From my vantage point, I was at Lehman Brothers in 1998 and doing a lot of long-dated equity vol. They were a big seller of Vega, very different than the zero DTE gamma intensive craze of today, but obviously very mark-to-market sensitive. And so you get something where the stuff can move pretty quickly. And they were among the few investors doing it, but they were so large that they became especially vulnerable when things started to move against them. I would love for you to talk about crowding. You mentioned that in the old days, the early days of distress, there were 15 to 20 entities that were big players in the market. I'd love to understand how that's changed over the years, but also just from an investor standpoint, I always want to know who's alongside me and whether they potentially become vulnerable and that vulnerability creates headaches for me. I know a lot of the distressed situations have predator clubs and so forth. Talk to us about crowding from your standpoint and how you evaluate and kind of avoid that risk.
As far as the stress is concerned, I still think it's a pretty small club. I actually think entrance into the club or what you need to be successful is different. I think 20 years ago, you could be more passive and again, just understand the process and following the court proceedings and how different creditors were to get treated. And you would definitely assert your rights, but it was more just like doing your homework and reading documents and understanding subsidiaries and the guarantees they had, and just the flow of funds and the waterfall. Where now, if you want to be a successful distress investor, you have to be super active. And you pretty much need a pretty big balance sheet behind you because you're having situations where creditors are clubbing up and changing indentures with votes and are able to put a class. Even if you thought a first lien, they're going to prime you with a new loan because they can. So if you're not in the room, and to get in the room, you've got to be bright, know what you're doing, and have good ideas, but you also have to have a pretty big checkbook. You're out of the room. And being out of the room right now is scary. It's a pretty binary situation. Many of these good distress players, are also kind of involved in the CLO market. So that might be a separate business, but it might be a source of where they're getting the heads up that a capital structure is teetering, so they can proactively go to their company and propose some kind of restructuring. And out-of-court restructurings, they're not good for you if you're not in the room. So I think that's a little different from the whole idea of crowding. It's like almost the reverse of crowding. Like you want to be with the crowd. You want to be on the inside. But yeah, like markets in general, I think it goes to indexing, right? Like where are the flows coming from? And credit markets are the ones that I guess I'm closest to, even though I'm not like necessarily active day to day. And whether it's investment grade or kind of par high yields or the CLO market, everyone's pretty much an index fund. If you're running a CLO, there's some exceptions. Let's say that the top 20% of CLO managers are actually trying to be different and being thoughtful about outperforming. But it's been a pretty good business in CLO since 2010, just to mimic the index in the sense of, hey, if I'm okay, if I'm average and I can gather funds and keep issuing more CLOs and getting more AUM, the margins of the business for the GP get better with size. There's some fixed costs and people. And then as I grow, it gets to be a better and better business, which again, I think is the same in investment grade and high yield long only management. Like size matters. So instead of trying to be an outperformer, probably one of the best credit investors as far as a long only was Dan Fuss. And he was always looking to outperform and be contrarian. And he was at Loomis Sales for a long time. And I think his son still does it. But his fund was a great fund, but it didn't grow nearly as much as Vanguard or PIMCO or BlackRock, because they were like, hey, if I can lower costs and just kind of be the index, that's a much better strategy. So that transformation of the credit markets in the last 15 years, that's basically like all the flows are binary. Like if money's coming into the market in IG and high yield, spreads are going tighter. And if money's coming out, spreads are going wider. We had some volatility, obviously, in 22. And then from the end of 22 to now, I mean, high yield has been a very good place to be. And that's super highly correlated with funds that have been coming into high yield, mutual funds and ETFs, which is pretty similar to the equity markets. The strategy of being bigger and lowering expenses from an asset management strategy has been much more lucrative than trying to outperform the market, which is hard. I'm not saying that's easy, but it seems like less people are trying.
I want to get a little into the weeds on some of your thinking on the current state of credit markets and maybe specifically the CLO business. You've taken to Twitter and you've really been posting some very thoughtful stuff. And one of them was on CLOs that you did last year. And I think there was some contemplation there of a credit cycle, this idea that we've had a seismic shift in rates from 0 to 5. I hadn't seen that in a long, long time. And there's likely to be implications. I guess we haven't really seen them just yet. But when I think about credit cycles, and I just love for you to weigh in on this, you had, of course, the financial crisis. I mean, that's a giant episode of contagion. Everything gets just shaken. The financial system gets vastly weakened. So spreads are just wider for a long time. We talked about the telco bust in, let's call it 2002. Maybe there's a mini cycle. It's energy centric in 2015 and 16. But where is the concept of a sustained and significant widening of credit spreads? Is that a thing of the past? How do you look at the concept of a credit cycle these days?
It's a great question. As someone that has done well in some credit cycles in the past, when spreads widened, defaults picked up, I'm definitely biased. I'm not going to deny it that maybe I'm too much of a Cassandra. With that said, like if you look at my personal portfolio, I'm pretty long. I have one short position that's a few percent. So, but I have probably more cash than a normal person, like as far as percentage wise, more cash, but like not crazy amount of cash. Listen, I like the vol, I like chaos. So I just enjoy change, I guess. And that's maybe callous. Like I don't want companies to default and go into business. I do want capitalism to get rid of excesses. But yeah, like it's a great question. And I do think with the rise in rates, it is surprising. I mean, defaults are picking up. They're definitely picking up. But you had, I guess, November of 22, ChatGPT came out. And I feel like that's just been a crazy bullish factor. I mean, there's just been so much capital put into AI, whether it's obviously buying chips, but data centers. And I think that factor alone has kind of pushed off the credit cycle. But with that said, of all the private credit, I can't remember whose index this is, but it's like somebody like Lincoln or Cliffwater, like someone that follows the credit cycles. 17% of private credit companies that have interest coverage ratios on 1 or less. And of those, 70% of the 17% are $100 million and less EBITDA companies. So I do think that the stress is happening at the middle market, lower middle market level. And I do think it's hard to see that stress with respect to prices because we don't know the prices of private credit. I mean, we did have a big default in private credit, Thrasio, which was Amazon reseller roll-up. And it was raised a decent amount of capital from both on the equity and the debt side from pretty well-regarded investors. So there's some stuff coming, but like, yeah, I mean, is productivity going to be amazingly increased because of AI? I think one day, I mean, AI though, right now, I was talking to a friend of mine the other day about this. It reminds me a little bit of fiber. And I don't want to talk about 25 years ago again, but like when Global Crossing Level 3, which both restructured, I mean, Global Crossing, that just liquidated. Level 3 still around. I can't remember. It got bought by somebody, Frontier, I think. Anyway, that was just a misallocation of capital. All the fibers used today, we're thankful that all that fiber was laid 25 years ago. And I don't know, maybe AI has eyes like that. I mean, the data centers, is it too much of a boom now? I mean, the difference being that the chips are depreciate, right? The actual fiber lasts for a long time. The chips depreciate, but the data centers near good power sources, they don't necessarily depreciate. So in my life, like the only use case currently today for AI is for high school and college kids to write papers. But I mean, that could change pretty violently, pretty quickly. But yeah, I do think we have a tale of two cities right now. I do think that there's some super interesting things going on with respect to AI, and just, wow, we might be in this new age. But then you've got some old school businesses that got levered up, bought by private equity, levered up by private credit, that might not be able to sustain 10+% interest payments for that long. So I don't think you can totally keep your eye off the ball.
So some of what you were talking about earlier there was not Cliff Asness and vol laundering, big soapbox issue for him, and I think for you as well. And the question is, and this is just around that series of tweets that you had sent last year around the CLO business. I found it extremely interesting. You're talking about this corporate financing vehicle, the loan, the leveraged loan, and this industry, this product, the CLO product that's built around it and is really a captive buyer of this product. And I think some of what you're pointing to, and I'd love for you to just expand on it, is just some of the risks that we should at least pay attention to, or at least imagine could be activated as a result of having such a captive audience of buyers. Maybe just walk through that a little bit.
Yeah, I mean, the CLO product has been a good product so far. It started around 2000 or so. CBOs were bad, just high yield bonds. And then CLOs were better because they were first lien loans, recoveries were higher. They held up in '08 in the sense that, yeah, equity lost and some of the subordinated, but like AAAs, AAs, they never got that part of the capital structure with losses. So roughly they're 10 times levered. So they buy $100 of loans and they have $10 of equity, and the rest of the cap structure is funded by the debt pieces starting at BB and all the way up to AAAs. So I think they represent around 70% of the new issue market, and that keeps going higher and higher. So just like equity indexing, it's like if you have one type of buyer that's motivated one type of way, when they're not buying, the market shuts down. So CLO managers, they'll issue a new deal when the arbitrage makes sense. And one of the biggest driver on the arbitrage is where they can place the debt. What spreads can they place the AAAs, which is the biggest part? So that's really important. Then AAs, single A's, triple B's, double B's. So where they can place the debt. So if the secondary tranches, AAA, AA, all the way down, are trading poorly, then their spreads widen out and you can't do a new deal. And like, what causes the secondary tranches to trade poorly? Well, that would be an increase in defaults and or, which is probably together, a drop in loan prices where there's more perceived risk of the equity returns and then the BB returns and what have you, spreads widen out. So I guess my point is, it's like, you've got this market that's disintermediated real credit decisions, in the sense that, like, if you're a CLO manager and you have a 1 or 2% position in all these different loans, you're doing credit work on the loans. I'm not saying you're not, but you're not going as deep because, one, you have a ton of competition with a bunch of other CLO managers that are kind of doing the exact same thing. So if you don't take a loan that's trading a little wider, then some other manager might take it and they might be able to offer a little better deal to their equity, and they might be a little more competitive and box you out. So there's some pressure that you're competing. And then you're like, oh, worst case, like, it's only a 1 or 2% position. I'm diversified. When you talk about diversification, you have to talk about correlation. So in 2008, we saw that first lien loan prices were super correlated because we had a bunch of hedge funds that were levered long on total return swaps and they got tapped out. The CLO product is better in the sense it's term leverage, so you can't get tapped out. But now that it dominates the market, from private market buying 75% of the new issue loans, if it gets shut down for extended period of time, that means companies can't refinance. And the liability to not refinance can cause a default on its own. So I do think just the concentration risk of the CLO market, I mean, it's real, right? Like there isn't going to be a CLO manager that like, hey, even though the equity is 0% return, I'm going to do a deal just because these companies need to refi. It's not going to work like that. It has to make sense. And then you can say, well, the companies can issue at wider and wider levels, but then, at some level, it's just like, well, does that even make sense for the company? Can they afford that interest? So I just think this concentration leads to correlation, if that makes sense.
Well, one company, I'll put that in quotes, that has pretty constant refinancing needs is the one that we live in, the country, US. And so what do you think about the US debt issue? There's a certain cohort out there saying, look, the alarmists have been complaining about this for a long time, and we're a giant economy with great seniorage from a tax standpoint. What's your thought on US debt? And then I've seen you talk a little bit about the blockchain and Bitcoin, perhaps linked to concerns around US debt.
I guess like I'm a closet Austrian. I thought modern monetary theory was pretty dumb. I'm glad that's like not necessarily as talked about.
It's still taking a victory lap somehow. I'm not sure why, but
Yeah. So I think they can kick the can for a while. And I could even argue, looking back at 2008, the idea of QE, which at the time I thought was inflationary, certainly wrong on. I can even argue that was a good idea. But I just don't think it can go forever. You get to the point, it's the gradually then suddenly moment. We live in New York City and I love New York. I don't think I'd make a lifestyle choice for taxes. I've paid a lot of New York City taxes, but like at some point, you're going to force me out. I mean, I'm not saying today, but like if they're like, oh, we'll just raise more taxes, like, okay, well, how does that work? Does it 75%? Like, I mean, do people stop working? There's clearly not enough revenue to service the debt at its current rate. I don't see the end game. If you just keep projecting it out, like, what is the solution to the deficits we're running? Maybe it's productivity, but it would have to be a ton of productivity. So I don't worry that tomorrow the US dollar is going to default. I definitely keep an eye on Bitcoin as somewhat of a barometer to it, but like it's not necessarily perfectly correlated. But I do see like the use case for other countries that aren't the reserve currency. There's definitely a decent amount of wealth going into Bitcoin as a way to be a store of value. So, I mean, to me, like Bitcoin is the only cryptocurrency that has a use case so far. But yeah, the deficit problem is tough. And I do think that like, while we might not be affected by it, our kids and hopefully grandkids, if we have grandkids, like they're going to be affected by it. Like, I just don't see the end game. No one's been able to explain, or I mean, if there is an explanation, I haven't read it yet on how this ends well.
yeah, sadly, it's not part of the political conversation. It's not exactly a vote winner these days, the notion of belt tightening. Cliff has this a little bit, kind of the godfather of factor investing, value and momentum. And I wanted to get some of your thoughts on just fixed income and credit market electronification. There's some advancements towards factorization of credit exposure using metrics like quality and value from a credit standpoint to put portfolios together. What do you see there, and where do you see that going?
2015, 16, I kind of had to change of heart. I was like, oh, there's 40,000 bond CUSIPs. Like, doesn't make sense like it does in the equity market where all the equity is fungible and you have one issuer with 150 different. But then I remember like reading about autonomous driving and all that. And I was like, well, if we can drive our cars autonomously, we can definitely trade bonds. We just need more computational power. And I started thinking about electronic markets and obviously market access and TradeWeb started getting more market share. Stocks were going up. Yeah. So, and then 2020, I led a seed round for a company called TradeWell. They've created an execution algo for the corporate bond market to interface with the exchanges. because I was thinking about the problem, and it's like it doesn't make any sense for voice trading. Electronic is definitely the way to go. The market keeps growing. The biggest mutual funds are some of the most sophisticated in trying to lower costs. They've really embraced the electronification of the corporate bond market. So all their rebalances are done automated, and they have their own algo. So they're there. You've got the big dealers, Goldman Sachs, Morgan Stanley, actually Jane Street jumped in a few years back, that are dominating that flow. You still have 90% or more of the corporate bond participants that are doing very few trades because they have to do them manually, which is kind of silly. They're not automated. So the time it takes. But we're seeing ticket sizes go down, just like equities 25 years ago. I started equities in the early 90s, and the block trading desk was like the center, and big blocks of stock would trade. And now rarely do blocks trade. Everything's electronified, and trading becomes less digital of big blocks and more analog of where it's constant flow of smaller pieces. And we're seeing that in the credit markets. And I think in the IG market, we're about 40% of our average daily volume, which is, I think last month was like 40 billion. So 16 billion is getting done in electronic form markets. And in high yield, I think it's about 30%. I don't know what the average daily volume is there. And that number 3 years ago was like 20, so it's doubled. Equities is like in the 80s. I don't think we get there, but I think we get to the 70s in IG and maybe the 60s in high yield. I think we get smaller blocks. I think we get more continuous pricing. And when you have those factors, those qualities of a market, then the factor investing becomes real. Like there's real signals. So I think we're in the early days. I think there's going to be more quants coming into the space in a big way. So yeah, I'm very bullish on electronic markets grabbing more and more of the daily volume. I'm very bullish on quants being able to have factor models and stat arb be effective in credit markets. And you're going to have some volatility, but I do think it's going to be a superior than the voice trading today as far as price discovery, liquidity, bid offer, all the things that it brought to the equity markets. I think it's going to happen, and it is happening, and the rate of change is picking up a bit.
Yeah, one thing I would say about the US listed options market, which I would say is just superior to all other markets, is that price discovery on the screen, ability to transact potentially in large size, and just knowing what that bid offer looks like and the stack on both sides of it. But as you say, 30 to 40% of the volume, that's extremely impressive. And I would say, just following it from an outsider standpoint, a huge amount of growth relative to a lot of the pessimism, just given this idea that each one of these bonds is unique. They have their own indentures. There's so many issues. Boy, that's pretty impressive, 30 to 40%. And so we innovate. Technology is a driving force for society, for markets. I would love to close, Kieran, just ask you to share some of your thoughts on financial innovation. We've talked a lot about optionality, and I think we've sort of talked about being short options and the risk of asymmetry, but finding things early can be a source of long optionality. You've talked about things like income sharing agreements, which I think are pretty interesting, a little controversial, but I think pretty interesting. Are there other areas of financial innovation that you think are exciting and promising? What's on your mind there?
Again, as far as like cryptocurrencies, I said Bitcoin has got the only proven use case so far to me, but the blockchain itself as a trustless ledger, right? You don't need the third party. I think it's so much financial innovation is going to come out of it. It's going to take time and there's going to be fits and starts, but the fact that Western Union still exists, charging, not against Western Union, they've been doing this forever and I'm sure they've helped people, but they're still charging 7, 8, 9, 10% to move money from place to place. That seems silly. And you talk about bid offer spreads and commission rates and everything, but like the credit cards still charge 2, 3, 4%. That seems silly. Like it seems like those rails need to be updated. So payments and the movement of money, to me, with respect to blockchain, just to give you like example, I have a friend that lived in London, US, citizen, lived in London for a long time, so I had citizenship in London and the UK as well. And they had a pound account in Barclays, JP Morgan, the US dollar account. And to move money, still to this day, between JP Morgan and Barclays, you gotta sell dollars, buy pounds, and then wire it. It's a multi-day, it's 2-3 days to do that. And like the blockchain is definitely better than that. So I just think there's, whether it's credit decisions or securitizations in the blockchain, but just moving money and payments, and then the tokenization, right? Like, why is there counterparty risk? And going back to AIG, like the blockchain solves that, right? So it's not going to happen tomorrow, but counterparty risk can be made much more efficient with the blockchain. And I think when you take away frictions and you take away commissions and heightened bid offers and the VIGs, you spur more growth. Like the cost of capital by definition goes down. And then you're talking about income sharing agreements. I do think that they are controversial, but like it comes back to this idea of cost of capital. Like we want to make the capital markets, the markets for capital, as efficient as possible so that those needing capital have options. And the price of capital is corresponding with the risk, and the risk can be more transparent. So the providers of capital can make decisions, and the intermediaries, I'm not saying the intermediaries don't perform a duty, but like, how can we make that as efficient as possible?
So interesting. Yeah, I agree. Well, Kieran, this has been a really interesting conversation. I'm very happy we had a chance to reconnect, and really appreciate the time to survey you on what's on your mind and learn a little bit more about your career history and present it to the listeners of the Alpha Exchange.
Dean, always a pleasure talking to you. Appreciate you reaching out, and enjoy your podcasts, and I wish you the best of luck and everything going forward.
I appreciate it. Thank you. You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.